Chapter 9 covers special rules related to cost recovery. This presentation is going to cover exceptions to the maker's depreciation rules that were covered in the last presentation. So the first exception that we need to talk about is very pro-taxpayer. It's called Internal Revenue Code Section 179. And what Section 179 allows taxpayers to do is to take an immediate deduction for the cost of assets that would otherwise have to be capitalized and depreciated via maker's rules. What Section 179 allows taxpayers to do is to take an immediate deduction up to $500,000 for the assets that they purchased during 2014. Okay, so if a company purchases assets that cost exactly $500,000 during 2014, if all of those assets were 5-year recovery assets, then under makers, the maximum tax deduction that they would get in 2015 would be 20% of $500,000. Well, Section 179 is much better than that, because under Section 179, a taxpayer can elect to deduct that entire cost. Okay, so up to $500,000 of asset purchases, you can elect to, instead of applying maker's rules and spreading the deduction out over time, instead you can just take an immediate deduction in the current tax year. Okay, so very, very taxpayer friendly, and this is preferred. An immediate deduction is preferred over having to spread the cost out and waiting for those deductions in some future year. So anything that we can't deduct under Section 179 is going to become our tax basis. So let's say we purchase assets and the total cost are $700,000. Well, under Section 179, we can take an immediate deduction of $500,000. That leaves us with $200,000 of assets that we can't take an immediate deduction for pursuant to Section 179. So the remaining $200,000 becomes our tax basis in these assets, and then we would apply the regular maker's rules to recover the rest of this basis, the remaining basis, for which we cannot deduct under Section 179. Okay, so this is very, very taxpayer friendly, and so we're going to put some limitations around who can benefit from this very generous Section 179 deduction. So the first limitation that you need to be aware of is a limitation based on the total assets purchased in a given year. Okay, so again, each taxpayer starts with an allowable Section 179 deduction of $500,000. However, if their total asset purchases during the year are more than $2 million, then we're going to reduce the amount that the taxpayer can deduct under Section 179. And we're going to reduce their Section 179 deduction. We're going to reduce that $500,000 deduction dollar for dollar by the amount their total asset purchases exceed $2 million. Okay, so let's look at this kind of middle bullet point. So let's say a business purchases personal property assets totaling $2.2 million during 2014. So these would be their total asset purchases. Now, once you see this, you should know that now we have a Section 179 issue because their total asset purchases are more than $2 million. Anytime your total purchases are more than $2 million, then you should know that the amount that you can deduct under Section 179, this $500,000 allowable deduction, is going to be reduced. And again, we're going to reduce it dollar for dollar by the amount your total purchases exceed the $2 million threshold. And so for this taxpayer, their total asset purchases are $200,000 more than the threshold. And so we have to take the $500,000 available deduction, and for this taxpayer, reduce the available deduction by $200,000 by the amount their total asset purchases exceed the threshold. And so this taxpayer's Section 179 deduction, instead of being $500,000, is going to only be $300,000. So they get an immediate deduction for $300,000 of their assets. The remaining $1.9 million of assets that they purchased, they have to apply the regular maker's rules and use regular depreciation rules to recover the cost of the rest of the basis of their remaining assets. Okay, so let's say we're this taxpayer. Okay, so we have $2.2 million of new asset purchases, and some of these assets might be 5-year assets, some of these assets might be 7-year assets, and so you're going to have to choose, right? You have to make a decision of which assets should you deduct under Section 179. You can take an immediate deduction of up to $300,000, of the cost of those assets. Well, which ones should you deduct under Section 179? You should always choose the assets with the longest recovery period. So if you have only 5-year assets and 7-year assets, you should immediately deduct $300,000 of the 7-year assets, because you're accelerating those deductions into the future. Okay, so you'd rather accelerate deductions that you'd taken 7 years into the future than deductions you would be able to take 5 years into the future. So we always want to choose the assets with the longest recovery period. Okay, and again, we're going to use makers for any remaining basis. Okay, so this is just kind of a full example of this concept. So again, we have a business that purchased total assets of $2.2 million. Now we look at the assets that they purchased, and $1.5 million of those assets were 5-year assets, $700,000 of the assets were 7-year assets. So again, in total, they purchased $2.2 million of assets. Okay, so the last slide showed you how we calculated this business's allowable Section 179 deduction. Instead of getting a $500,000 deduction, this taxpayer gets a $300,000 deduction because their total asset purchases are more than $2 million. And so this taxpayer, they get a deduction of $300,000. They need to decide, should they deduct the cost of the 7-year assets or the 5-year assets? And again, always choose the asset with the longest life. And so this taxpayer would choose to deduct $300,000 of the cost of the 7-year assets. Okay, so anything that you can't deduct under Section 179, you use regular maker's depreciation rules for. So Section 179, we're going to deduct $300,000 of the cost of the 7-year assets. And so what does this leave us? This leaves us with a basis in our 5-year assets of $1.5 million and basis in our 7-year assets of $400,000. And with this remaining basis, we're going to apply regular maker's rules. And so if you go and look at the half-year convention table that I presented in the last presentation, the first year percent for 5-year assets is 20%. The first percent or the year 1% for 7-year assets is 14.29%. And we're going to use those percentages to determine how much maker's depreciation we can take for our assets in 2014. So our total cost recovery deduction, if this is a situation, if we purchase $2.2 million of assets during 2014, our total cost recovery deduction for 2014 is going to be $657,160. Where did this number come from? This number is the $300,000 Section 179 deduction, and then the $300,000 of makers for the 5-year assets, and the $57,160 maker depreciation deduction for our 7-year assets. So that's where this total number comes from. It's just the sum of our Section 179 deduction plus our regular maker's depreciation for the first year. Okay, so we purchased $2.2 million. How much can we deduct in the year of purchase? We can deduct $657,000 of the cost of those assets in the first year. Okay, so this would be, in the last presentation, we talked about cost basis versus tax basis, and I said that that's not always the same number. This would be an example of when our cost basis would not equal our initial tax basis. So we look at our 7-year assets, the amount that we bought them for is our cost basis, right? The cost basis is always the purchase price. Our purchase price is $700,000. Our tax basis is the amount that we have not yet received a tax deduction for. So for these 7-year assets, our cost basis is $700,000, where our initial tax basis is going to be $400,000. The difference is this immediate deduction of $300,000 that we get pursuant to Section 179. So this would be an example of cost basis of $700,000 does not equal tax basis of $400,000. Okay, an example of when those two numbers aren't going to be the same. Usually they are, but sometimes they're not. Okay, so this is the Section 179 deduction example. There's one other limitation associated with Section 179, and this limitation says that Section 179 can only bring your taxable income to zero. Section 179 cannot create a net operating loss. Okay, so let's say that a company purchases $100,000 of assets during 2014. Well, Section 179 says they can deduct the total cost of those assets, right? Section 179 says you can deduct up to $500,000. This company only purchased $100,000 of assets, so without looking at the limitation, this company, it appears that a company would be able to deduct all $100,000 of what they purchased. But if this company's net income before looking at Section 179 was only $75,000, well, then their Section 179 deduction, instead of being $100,000, would be limited to just $75,000. Okay, so with Section 179, you can bring taxable income to zero, but you cannot create a loss. Any carryover, okay, so any amount that you can't deduct under Section 179 because of this net income limitation, it becomes a carryover, and you can deduct it in the next tax year. Okay, and we'll go over an example of this in class. Okay, so that was the first exception to maker's depreciation, Section 179, very taxpayer friendly, and we discussed, the general rules and then the two limitations, right? The total purchases limitation and the taxable income limitation could potentially limit a taxpayer's ability to deduct $500,000 under Section 179. The second very taxpayer-friendly exception to makers is bonus depreciation. So bonus depreciation is meant to stimulate the economy. The first time we saw bonus depreciation was after 9/11. Congress initiated or enacted bonus depreciation to encourage businesses to go out and buy more stuff to stimulate the economy. So what is bonus? And since 9/11, this is something that Congress brings back. Okay, anytime the economy starts to get slow, okay, especially during the recession, bonus depreciation came back. It allows more of an immediate deduction to encourage companies to purchase more assets, okay, to try to give the economy a boost. So for 2014, the bonus depreciation percentage is 50%. So Congress brings back bonus depreciation whenever the economy is in trouble, and it brings it back at various percentages. So in some years, bonus depreciation has been 30%. In 2011, bonus depreciation was 100%, very, very taxpayer friendly. But for 2014, anything we purchase is subject to, or we can elect to take 50% bonus depreciation for things purchased in 2014. Okay, so basically, if we buy property, it has to be brand new property, and it has to have a recovery period of 20 years or less. But as long as it's brand new with a recovery period of 20 years or less, we get an immediate deduction in the year of purchase of half of the cost of the asset. Okay, that's what bonus depreciation allows us to do. It's a 50% immediate deduction in the year of purchase. Okay, anything that we can't deduct under bonus depreciation becomes our tax basis for makers, and we depreciate the rest of the asset using regular makers depreciation rules. So in any given year, we might have the ability to take Section 179, to take bonus, and to take regular makers depreciation. And if we can take all three, the order in which we would take the deductions would be Section 179 first, and then bonus with any remaining basis, and then makers for anything that's left over. So let's look at an example. This example is what we looked at under Section 179. Let's just look and see what happens when we add bonus depreciation to this example. So we have a taxpayer that purchased $2.2 million of personal property during 2014. We already talked about Section 179. The taxpayer can deduct $300,000 under Section 179, leaving basis in the 5-year assets of $1.5 million and basis in the 7-year assets of $400,000. Right? We're going to take our deduction and take an immediate deduction for the 7-year assets first. So this would be our remaining basis after Section 179. So after we deal with Section 179, then we're going to apply bonus depreciation. So for 2014, bonus depreciation is 50% depreciation. So for our 5-year assets, our basis is $1.5 million. Bonus depreciation allows us a first-year immediate deduction of $750,000. Okay, half of the cost of the asset. And we can do for the same for our 7-year assets. After we take Section 179, our remaining basis is $400,000. We apply bonus depreciation, or a 50% immediate deduction, and our bonus depreciation related to these 7-year assets is $200,000. Okay, so we've applied Section 179, we've applied bonus. After we've applied both of these, we still get our first-year makers depreciation deduction too. Okay, so we still get makers in 2014. So how much basis do we have left in our 5-year assets after applying Section 179, after applying bonus depreciation? We still have basis of $750,000 in our 5-year assets. Our first-year makers percentage is 20%, and so our first-year makers depreciation deduction is $150,000. For our 7-year assets, how much basis do we have after 179 after bonus? We still have basis of $200,000 in those assets. Our percent is 14.29% under makers, and so our first year makers depreciation deduction for our 7-year assets, 28,580. Okay, so we reduce our basis every time we get a tax deduction, and that's where we're coming up with this basis that we're then using under the makers system. Okay, so for this taxpayer, once we apply bonus depreciation, their first year deduction is $1,428,000 and some change. Okay, so where does this number come from? This total cost recovery deduction is the amount they can deduct under Section 179 plus the amount that they can deduct under bonus depreciation rules plus the amount that they can deduct under makers. Okay, so a big, huge deduction of the $2.2 million of stuff that they bought during 2014. In the first year in 2014, they can take a tax deduction of $1.4 million. Okay, most of this deduction is driven by Section 179 and bonus depreciation. Okay, these are exceptions to makers, very taxpayer friendly exceptions to makers. Okay, so we'll go over more detailed examples in class. So just a couple other depreciation topics to hit to kind of end this discussion of depreciation. So there are assets that are called listed property, and this property would be assets that would have both a personal and business use associated with the asset. And so something you can think of cars. So let's say your company gives you a car and allows you to drive that car on the weekends, then that car has a business use to it and also a personal use. Let's say your company gives you a computer to use and you can bring that computer home and play on Facebook or play games or do shopping on it. Well, your computer has a business aspect and a personal aspect to it. So assets like this, which have a business use and a personal use, we're going to call these assets listed property. And this slide talks about how we're going to calculate depreciation for listed property. So the first thing we need to do is figure out how much of the total use of the asset, how much is business versus how much is personal. Okay, so if the business use is more than 50%, then the calculation is relatively easy. So as long as the business use is more than 50%, then we're going to calculate depreciation under the rules we already know. We're going to come up with total makers depreciation, and then we're going to take that total number and multiply it times the business use percentage. Okay, so this is how we're going to deal with it if our business use is more than 50%. If our business use is less than 50%, then we're going to compute depreciation using the straight line method and using the alternative recovery period. Don't worry about this bullet point, okay? Don't worry about it so much. Conceptually, what you need to understand is you're going to get significantly less depreciation if your business use is less than 50%, okay? Then you're under different rules. But I do think that you should be able to handle calculations that are more similar to this first bullet point, okay? So if you have a computer, you use it 90% of the time for business, well, then you just go to the makers table based on the total cost of the asset, figure out what your makers depreciation expense should be, take that amount times 90%, and that's the tax depreciation deduction that you get to take for the year, okay? There are special rules if you start off using an asset more than 50% of the time for business and then that usage falls to less than 50% of the time. Just know that there are special rules, and if you come to a situation like this, you need to get out your tax textbook and figure out the correct treatment. Okay, it gets a little more complicated when the business versus personal use percentages change. Okay, but so for this slide, what I think is important is just understanding this first bullet point right here. What happens if the business use is more than 50% but less than 100%? I think you should be able to calculate depreciation under that scenario. Okay, and then the last kind of special depreciation topic that we need to talk about are for luxury automobiles. So Congress doesn't want to subsidize the company's purchase of really expensive automobiles, and so they're going to place a limit on the amount that a business can deduct in depreciation for automobiles. Okay, so for 2014, if we're using the half-year convention, then these limitations are going to apply to any vehicle that we purchase that costs more than $15,800. Okay, so once we purchase a car that costs more than that, then we need to worry about these luxury automobile limitations. Okay, and so what we need to do if we're a business and we have automobiles that we're depreciating is we're going to calculate how much depreciation we should get under makers. Okay, so automobiles are 5-year recovery assets. So we're going to take the cost of the asset, we're going to apply the regular makers rules, to figure out how much depreciation Makers tells us we should be able to take. And then we're going to compare that to amounts provided to us by the IRS. And so you should refer to Exhibit 9-8 of your textbook on page 9-27. And this is going to provide you the limits that the IRS gives us. And these limits are going to be different based on the tax year. Okay, so that in the textbook, if you look at this Exhibit 9-8, it's going to provide you the limitations for 2014. So you're going to calculate what the Makers table tells you depreciation should be. You're going to compare that to the maximum amount that the IRS tells you you're allowed to take, and your depreciation deduction is going to be the lesser of those two amounts. Okay, so basically figure out depreciation. If what you've calculated is more than what the IRS tells you can take, then you're limited to what the IRS allows. Okay, so this is going to apply to a lot of automobiles. Basically any automobile with a purchase price of more than $15,800. Now we have to worry about these limitations. Interestingly, this limitation does not apply to vehicles weighing more than 6,000 pounds. And so if you're very concerned about getting all of your depreciation as a business owner, then what you can do is purchase, big, huge, heavy SUVs. And as long as the weight of the SUV is more than 6,000 pounds, then you are not limited by these luxury automobile limitations, and you can always take 100% of the Maker's depreciation that you calculate using the table. Then these limitations would not apply to you. Okay, so those are the rules for luxury automobiles. And then finally, for alternative minimum tax, the only thing I want you to know for depreciation for AMT is that it's different. Okay, instead of using the 200% declining balance method under alternative minimum tax, you can only use 150%, the 150% balance method. And so depreciation is going to be different for regular tax purposes versus alternative tax purposes. And the difference is going to be either a plus adjustment or a minus adjustment to your alternative minimum taxable income. Okay, you don't need to know how to calculate it, just know that it's different, and it's going to create an adjustment for when we calculate our AMTI. We will go over lots of examples in class.